Good morning. I'm Jen Amos at Weiss Research.
I'm Andy Myers, and this is your morning market update for Friday, November 18th. After 2 days of selling on Wall Street, stocks are posting some small gains in early trading. Investors seem to be taking some comfort from actions by the European Central Bank to stem the region's sovereign debt crisis. Analysts say the ECB intervened in the bond markets this morning, buying the government debt of so-called periphery countries. The move is an effort to halt the recent sell-off in Italian and Spanish bonds, but it doesn't seem to be having the intended effect. The yield on Italy's benchmark 10-year note is back above 7%, the level at which Greece and Portugal were effectively shut out of the credit markets. And Spain's benchmark bond is now yielding more than 6.7%. However, while the credit markets haven't quite stabilized yet, the ECB's actions are helping European stocks erase their earlier losses. And the region's shared currency is also making up some ground. Right now, the euro is once again closing in on the 136 mark against the US dollar.
Aside from the central bank's intervention in the bond markets, European leaders are also searching for other ways to stop the debt crisis in its tracks. One proposed solution would be for the ECB to lend money to the International Monetary Fund, which would then finance bailouts for struggling Eurozone nations. Despite Germany and the ECB's continued opposition to this plan, Dow Jones Newswires reports that it's gaining traction in the absence of any viable alternatives. Meanwhile, ECB President Mario Draghi pressured Eurozone leaders to implement measures designed to combat the debt crisis, which they agreed to months ago. In theory, the European Financial Stability Facility should now have the power to buy the government debt of struggling nations directly. A big increase in the bailout fund size was also authorized, but neither change has been finalized yet. At this morning's banking forum in Frankfurt, Draghi also called for stronger governance within the Eurozone.
Turning to corporate news, the biggest name on this morning's earnings calendar is H.J. Heinz. Fiscal second quarter profit at the food company fell 5.7% as weaker consumer spending in North America and lower volume cut into international sales growth. Heinz has been forced to raise prices on many products amid higher commodity costs. And now the company says it will have to close 3 more factories. Shares of Heinz are dropping nearly 2% on the news. Another big stock decliner this morning is Salesforce.com, down 8%. After yesterday's closing bell, the cloud-based software firm said it swung to a loss in its latest quarter. The results did beat estimates, as did the company's top-line number, but billings fell short of analyst forecasts.
We do have a couple stock winners to tell you about this morning. Dr. Pepper Snapple Group is rising 1% after its board authorized the repurchase of an additional $1 billion in stock. The move brings the beverage company's total buyback to $3 billion. Meanwhile, Nike declared a quarterly dividend of 36 cents a share, a 16% increase over its prior payout. Nike is adding about 1% on the news. And finally, keep an eye on shares of Boeing. It confirmed an order from Indonesia's Lion Air for 230 planes at a list price of $21.7 billion. That makes it the largest commercial jet order in Boeing's history. The deal is for 201 737 MAXs and 29 extended-range 737-900s. And it also includes purchase rights for an additional 150 planes valued at more than $14 billion. That's the latest from Weiss Research. Have a great trading day and a fabulous weekend.